Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Palantir.
If you find our talks useful, please consider subscribe, like, and comment underneath. Imagine for a second firing your entire corporate leadership team.
Right, just completely clearing house.
Yeah, your chief operating officer, your head of logistics, your CFO, and just replacing them all with a chatbot. Sounds completely insane, right?
It sounds like a disaster waiting to happen.
Exactly. Yet some of the biggest, most influential investors on Wall Street are actively betting that this is exactly what's about to happen to Palantir's core business model.
Yeah, it's wild.
We're looking at a massive, absolute contrarian battleground today. Palantir is violently tearing the market in two entirely different directions right now.
They really are. It's totally polarized.
On one side, you have them putting up these staggering growth numbers and locking down government tech monopolies. But then on the other side, you have high-profile investors warning of imminent doom, claiming the entire operation is about to become obsolete overnight.
Literally overnight, yeah.
So the goal for our analysis today is to cut through that screening headline noise. We need to figure out the actual wealth-building potential here. What is the real story hiding beneath all the panic?
I wouldn't just call it polarized. I'd call it violently divided.
Oh, for sure.
When you have a market splitting this drastically, the truth isn't found in the latest dramatic tweet. It's hiding in the underlying data.
Always in the data.
Right. And right now, the data reveals a tremendous amount of quiet, strategic accumulation happening in the background by institutional money. But to understand why the smart money is moving the way it is, we have to start by looking at the raw, undeniable numbers.
The fundamentals.
Exactly. The numbers that have cemented Palantir at the absolute center of the artificial intelligence revolution.
Right, because before we get to the skeptics, and believe me, we're going to unpack the haters and the whole obsolescence theory, we have to acknowledge the fundamental juggernaut this company has become.
Yeah, the recent quarter was just huge.
Let's pull up the data from that. Wall Street was expecting Q4 revenue to come in around $1.34 billion. Instead, they completely shattered that. They delivered $1.407 billion.
Which is a massive beat.
It is, and you have to put that into context for a second. We are in a macroeconomic environment where every major corporation is tightening their belt. Enterprise software budgets are getting slashed across the board.
Yeah, nobody is spending on luxuries right now.
Exactly. So for a company to deliver an earnings beat of that magnitude right now, it sends a massive signal that their product isn't seen as an optional luxury. It's being viewed as mission-critical infrastructure.
And it goes far beyond just a single strong quarter, too. What really forces you to pay attention is the forward trajectory. Management isn't playing it safe at all.
No, they are leaning into it.
They just issued this aggressively ambitious 2026 guidance. They are targeting $7.19 billion in revenue.
Wow.
Yeah. When you run the math on that, you are looking at roughly 61% year-over-year growth. For a company operating at this massive scale to suddenly hit the accelerator and project 61% growth.
It's unheard of.
It tells you that their artificial intelligence platform, what they call AIP, is experiencing explosive adoption. And crucially, that adoption is heavily concentrated in the United States commercial markets.
Which proves they are no longer just a secretive defense contractor.
Right. They are breaking into the mainstream enterprise space.
And the financial structure backing that growth is incredibly rare for a tech company in this phase. They have what I look at as a fortress balance sheet.
Oh, absolutely.
They have a massive cash stockpile relative to virtually non-existent debt. This gives them a level of operational flexibility that their competitors simply do not have.
They aren't held hostage by interest rates.
Exactly. They are generating huge amounts of free cash flow. And instead of needing to go to the debt markets to fund their operations, they are pumping that cash right back into research and development.
They are successfully pulling off the holy grail of tech, really, transitioning from a high-touch, consulting-heavy service into a scalable, high-margin software powerhouse.
And here's where I want to hit pause for a second.
Yeah.
Because the bulls constantly throw around this one specific phrase when defending the stock, and I think it confuses a lot of retail investors.
Oh, I know exactly what you're going to say, the ontology layer.
Yes. They keep talking about Palantir's ontology layer. What exactly is an ontology layer, and why is it supposedly this impenetrable moat?
It is the single most important concept to understand if you are evaluating this stock. The ontology layer within their founder system is what separates them from the typical AI hype cycle.
Okay, break that down for me.
To understand why it's a moat, look at what the rest of the market is doing. Most tech giants are currently selling generic large language models to businesses.
Like your standard chatbots.
Right. These models are incredibly smart. They can write code, they can draft emails, but they are generic. They don't actually know the business. Palantir's ontology acts as a universal translator across a company's entire operation.
So it connects the dots.
Exactly. It takes the siloed accounting data, the warehouse management systems, the HR databases, and it links them all together to create a living, breathing digital twin of the business.
Oh, wow.
The AI isn't just answering trivia questions. It is physically mapped to the operational levers of the company. That creates a deeply embedded switching cost.
Okay, so let me translate that into a real-world scenario because I think I see the disconnect here.
Yeah.
Let's compare generic AI models to Palantir's ontology. It's like comparing a brilliant but totally naive intern to a veteran chief operating officer.
I love that analogy. Yes.
Right. The generic AI intern has read every textbook ever written. It knows all the academic theories of supply chain management. But if you put that intern in your specific office, it has absolutely no idea who approves the budgets.
Or where the warehouse keys are kept.
Exactly. Or which supplier is chronically late. Palantir's ontology is that veteran COO. It maps the data directly to how your specific company breathes.
Right. It knows the quirks of the organization.
And once you have a COO like that running your global supply chain, you don't just fire them on a Tuesday because a new, smarter intern showed up.
That is the exact dynamic playing out in the enterprise space right now. That massive operational dependency is why we are seeing unprecedented contract consolidation.
It really makes them sticky.
Extremely sticky. The research actually highlights a recent United States Army deal that perfectly illustrates this. The Army took 75 separate fragmented tech contracts.
Maybe 75.
Yes, 75 different vendors, different data silos, different security protocols, and they consolidated them all into a single agreement with Palantir.
That is insane. Think about the nightmare of military bureaucracy. For them to rip out 75 systems and hand the keys to one single company, that just shows you the raw power of that ontology.
In a world of increasing geopolitical instability, the defense apparatus is realizing they can't rely on piecemeal tech anymore. They need a single, reliable central nervous system.
And once you become the central nervous system for the U.S. military, your revenue base becomes almost impossible for rivals to displace.
Exactly. The switching costs are just too high.
But wait, hold on. If they are literally locking down the U.S. Army and the switching costs are as astronomical as you say, why is there such extreme panic in the market right now?
That's the million-dollar question.
I mean, if you hold this stock, you're getting whiplash. The sentiment in the financial news is incredibly negative lately. If the moat is impenetrable, why the sudden wave of high-profile haters?
The panic stems from the sheer terrifying speed of AI advancement. The market is absolutely obsessed with the threat of sudden obsolescence, and that brings us directly to the bear case, which is gaining serious traction.
Right. You mentioned high-profile investors earlier. Michael Burry recently issued a very stark public warning.
He did. He essentially claimed that Anthropic, one of the leading AI research labs, is, quote, eating their lunch.
Yeah, and when the big short guy speaks, people tend to panic. The stock took a serious hit on those comments. But what is the actual mechanics of his fear? Like, why would a company that builds chatbots threaten Palantir's government dominance?
The specific fear is about autonomous AI agents. Anthropic is developing frontier models that don't just answer prompts. They can be given a complex goal and independently execute the steps to achieve it.
So they act on their own.
Exactly. The bare thesis is that these autonomous agents will become so incredibly capable so quickly that they will completely bypass the need for Palantir's intricate custom software builds.
Okay, I see. Because Palantir has traditionally relied on a seat-based subscription model, right? Often requiring their own engineers to help set up the systems.
Yes, it's very hands-on. The market is terrified that Anthropic's agents will allow companies to just plug a raw AI into their raw data and get the same result instantly without paying Palantir's premium fees.
Okay, but we have to talk about the other massive elephant in the room driving this fear, and that is the valuation. Because even if you believe in the COO analogy, the premium this stock commands right now is staggering.
It is definitely priced for perfection.
We are talking about trading at 238 times earnings and 80 times sales. Let's be clear for anyone listening. 80 times sales is a terrifying neighborhood to live in.
It really is.
And looking at the data, government contract growth recently slowed down to 42%, down from 66% prior. We need to explain why that matters. Let's use the explain it like I'm 5 standard for multiple compression.
Good idea.
When you're priced at 238 times earnings, you are priced to absolute flawless perfection. It's like paying 200 times the annual rent to buy a house, assuming rent will double every year forever.
Right. And if it doesn't?
If growth slows from 66 to 42%, the market violently recalculates what the house is worth. That multiple compression can wipe out retail portfolios in an instant, even if the underlying company is still growing.
And that is exactly what the bears are pointing to. A 238 times multiple means there is zero margin of safety. None.
Literally none.
If Anthropic releases a new shockwave model that makes Palantir software look even slightly outdated, or if that U.S. commercial growth narrative misses by a fraction of a percent, the floor will completely fall out from under the stock.
The bears are looking at the math and concluding the risk-reward ratio is totally broken.
Exactly.
But I get the math, I really do. But I have to push back hard on this Burry narrative regarding obsolescence. Are we sure the market isn't blindly conflating raw intelligence with actual messy enterprise integration?
It's a very valid point.
Going back to our analogy, just because Anthropic builds a genius-level intern doesn't mean that intern knows how to navigate the regulatory nightmare of a Fortune 500 healthcare provider.
No, it definitely doesn't.
And as for the valuation, which, yes, is a guillotine hanging over the stock, doesn't their own guidance kind of neutralize that over time? I mean, if they actually hit that 61% growth target to reach $7.19 billion in revenue, the denominator in that equation gets so big that the multiple compresses organically without the stock price having to crash.
That is the exact counter-argument the bulls are leaning on. If execution remains flawless, they will just grow into that valuation. The challenge is asking Wall Street to be patient in a sector that literally reinvents itself every single week.
Right, patience is not Wall Street's strong suit.
Not at all. But here is where our analysis gets really interesting. If Michael Burry is right and obsolescence is right around the corner, you would expect institutional money to be running for the exits.
What we are seeing the exact opposite.
We really are.
Yes. This is where the true wealth-building strategy starts to take shape for you as an investor. You have retail investors panicking, selling the stock because of scary headlines about AI agents. But when you look at the smart money, the institutional players, they are quietly backing up the truck.
Exactly the opposite of panic. Despite the bearish headlines, the underlying analyst actions are remarkably bullish. Let's break down the mechanics of why.
Let's do it.
UBS Group recently issued a major upgrade, and their entire thesis validated that exact ontology moat we just discussed. They argued that Palantir's ability to map corporate operations is a structural, physical barrier against competition.
Protecting them even from the massive hyperscalers like Microsoft and Google.
Exactly. Then you look at Rosenblatt. They didn't just maintain a buy rating, they aggressively hiked their price target from $150 all the way up to $200.
Wow. And their reasoning was entirely grounded in the reality of government operations, right? They cited specific government mandates as a tailwind, which flies in the face of the Anthropic is taking over narrative.
Precisely. And the momentum doesn't stop there. Piper Sandler reaffirmed their overweight rating at $230, and Wedbush maintained an outperform at $230.
Which is a huge vote of confidence.
But Wedbush's logic is critical here. They anchored their target heavily on Palantir's partnership with NVIDIA because NVIDIA provides the raw brute force computing hardware. But hardware is totally useless to an enterprise without the software layer to direct it.
Palantir is the steering wheel for NVIDIA's engine.
That's a perfect way to put it. What you are seeing is institutional research desks completely ignoring the headline fear and focusing entirely on how sticky this software actually is.
There's a fantastic note from Barclays in the research that really nails this dynamic. They pointed out that smart money is deliberately rotating back into what they call sticky incumbents.
Because they know the reality on the ground.
Exactly. Institutional investors understand a reality that retail investors often forget. Migrating enterprise data is like performing open-heart surgery on a patient while they're running a marathon.
It's incredibly risky.
You don't just rip out your entire data infrastructure on a random Tuesday, because Anthropic dropped a cool new AI model on Monday. It takes years of rigorous testing, compliance, and integration to safely migrate enterprise systems.
And speaking of the reality of government tech, we have to address this massive speculative rumor circulating right now.
Oh, yes. We have to talk about this.
There is chatter about a potential United States government mandate to phase out the use of Anthropic's models entirely over a 6-month period.
Because of security and governance concerns, right?
Exactly. If that actually happens, it would push billions in lucrative contracts directly toward Palantir's highly vetted closed-loop solutions.
I mean, we definitely have to treat that rumor with caution until we see official Q2 contract announcements.
Oh, for sure. It is still just a rumor.
However, logically, it makes perfect sense. Geopolitical realities dictate that the Department of Defense and major government agencies will always prioritize absolute security, auditability, and governance over raw computing novelty.
They cannot afford a black box AI hallucinating during a critical supply chain operation.
No way. They need systems that trace every single decision back to the source data, which is Palantir's specialty.
It really is a classic case of watch what they do, not what they say. The headlines scream about obsolescence and AI disruption, but the big banks are using those headline-driven dips for stealth accumulation.
So if you are listening to this and trying to manage your portfolio, how do you safely navigate an environment with these massive conflicting forces? You have the fundamental screaming buy and the valuation screaming danger.
You navigate it by zooming out, look closely at the technical setup, and specifically map the timeline of impending catalysts. This fundamental tug-of-war is perfectly mirrored in the recent, highly erratic price action on the chart.
It's been a wild ride.
If you are holding the stock, you are experiencing extreme high beta volatility.
Let's explain that for a second. High beta volatility essentially means this stock acts like a speedboat in a hurricane, while the rest of the market is an ocean liner. It feels every single macro wave, completely magnified.
Look at the recent action. The stock surged 18.2% on macro news about a tariff pause. Massive elation.
Like-
Then, almost immediately, it plummeted 7.3% to a one-month low based purely on competitive fears regarding Anthropic.
It's just violently whipping back and forth.
And then just as quickly, it jumped 6% in a single session when analysts came out and called the recent software sector sell-off, the so-called Syspocalypse, deeply oversold.
Right now, it is fighting psychological resistance just below its 200-day moving average.
And the 200-day moving average isn't just a line on a screen. It is the psychological line in the sand where massive institutional algorithms decide whether an asset is in a long-term uptrend or downtrend.
It's a huge technical low.
The fact that it is fighting right at this level tells us the stock is trapped in a massive accumulation phase. The headline fear from retail sellers is hitting directly against the greed of institutional buyers stepping in to support the price. This creates intense compression.
Looking at the chart, it looks exactly like a pressure cooker or a tightly coiled spring. You have this classic volatility squeeze happening. Institutional accumulation is compressing against retail panic, and they are both just sitting there, waiting for a spark to blow the lid right off.
And the entire market knows exactly what that spark is going to be. It's the May 4th crucible.
Q1 earnings.
May 4th is the absolute moment of truth. They have a tremendous amount of structural momentum heading into this date. Their ongoing AIPCon events are successfully driving commercial enterprise adoption.
Plus, you have global geopolitical instability acting as a massive tailwind. The ongoing defense negotiations and ceasefire discussions historically boost defense contractors.
But absolutely none of that macro momentum matters if they don't deliver the hard numbers on May 4th. They have to prove to the market that their 61% growth trajectory is grounded in reality.
But let's be real about the stakes here. Is May 4th purely binary? Think about the math we discussed earlier. If they miss their commercial revenue target by a fraction of a percent, does that 238 times valuation cause the floor to completely give out? Do we see instant multiple compression?
At 238 times earnings, the market is entirely unforgiving. If they show any sign of weakness, particularly in that critical U.S. commercial growth narrative, the multiple compression will be severe and immediate.
So a violent repricing downward.
Yes. However, the inverse is also true. If they beat expectations, and more importantly, if management steps up to the microphone and confidently reaffirms or even raises that $7.19 billion target for 2026, the stock is going to shatter that 200-day resistance, with incredible violence to the upside.
All right, let's bring this all together. We need to synthesize the technical squeeze, the fundamental growth, and the extreme sentiment data into a clear, actionable, wealth-building takeaway for you listening right now.
We have to weigh all the factors.
We have weighed the staggering 61% growth projections against the genuinely terrifying valuation risk. We have looked at the reality of the ontology moat versus Michael Burry's obsolescence thesis.
When you aggregate all the data and strip away the emotion, our analysis delivers a final convicted bullish score of 7.5 out of 10.
7.5.
Nice. The fundamental strength of the business and the deeply entrenched nature of their software moat significantly outweigh the short-term, headline-driven volatility. What the data shows is a profoundly successful transition.
They really have evolved.
They are no longer just a secretive niche defense contractor. They have evolved into a true foundational AI powerhouse for global enterprise.
And as for the optimal timeline to target, the current technical setup heavily points to a strategic swing trade leading right into that May 4 earnings catalyst. You are positioning yourself to play the volatility squeeze.
Exactly.
But you enter that trade with a view to hold for the long term if and only if their $7.19 billion revenue guidance proves resilient. If that fundamental juggernaut keeps rolling, that scary valuation multiple will organically compress itself over time as the earnings catch up to the price.
But it requires active vigilance. You cannot simply buy a stock at these multiples, close your app, and forget about it. You have to monitor the commercial adoption rates closely. But the institutional rotation we are seeing heavily suggests that the smart money has already placed their bets that the ontology moat will hold.
Exactly. Follow the money, not the panic. I want to leave you with one final provocative thought to mull over as you look at your portfolio today. We talked about the United States Army earlier.
The ultimate bureaucracy.
Right. Historically, the military is one of those stubborn, bureaucratic, red tape-heavy institutions on the face of the earth. If an entity that entrenched can manage to completely rip out 75 different disjointed legacy contracts and consolidate their entire operational data into Palantir's single AI brain, what does that imply about the eventual adoption curve waiting for us in the private sector?
It's a huge leading indicator.
It really is.
Yeah.
If you think about the pain of that migration, are the bears radically underestimating the sheer massive scale of the operational dependency that Palantir is quietly building right in front of our eyes? Think about that before you let a headline scare you out of a position. We'll see you tomorrow.